A recent report from macro research firm Citrini titled, "The 2028 Global Intelligence Crisis," went viral, with some alleging it was the catalyst for a market crash. The report's central thesis outlined a hypothetical future where the widespread adoption of artificial intelligence would trigger a severe downturn for both the broader economy and financial markets. In essence, the report argues that AI could displace a significant portion of the white-collar workforce, leading to a sharp decline in consumption and investment. Since the economy is fueled by consumption and markets are heavily reliant on passive investing, both would face immense pressure. Alp Shah, co-author of the report and CIO of the AI-focused investment firm Lotus Technology Management, believes this scenario could unfold as soon as 2028, citing recent breakthroughs in AI agent technology. Before delving into the report's arguments, two crucial caveats must be addressed. First, the document explicitly states from the outset, what follows is a scenario, not a prediction. The stated intent was not to create alarmist, bear porn, or AI doom or fanfiction, but rather to model a relatively underexplored possibility. Nevertheless, the market largely interpreted it as a firm prediction. This ties into the second point, the report's main argument, that AI will suppress white-collar wages, thereby reducing consumption and harming the economy, is a well-discussed potential side effect of the technology. This suggests the report was likely not the sole cause of the market drop in late February. However, in a subsequent Bloomberg interview, Shah admitted that his firm, presumably Lotus Technology Management, held short positions on several companies vulnerable to AI disruption. In other words, they were betting against some of the very stocks that declined after the report's release. Yet, there's another layer to this. Many of those same stocks were already on a downward trend before the report ever surfaced. The report itself begins with a theoretical dispatch from June 2028. The unemployment rate printed 10.2% this morning, a 0.3% upside surprise. The market sold off 2% on the number, bringing the cumulative drawdown in the S&P to 38% from its October 2026 highs. The cause, of course, is the increasing replacement of white-collar workers by AI agents. The authors describe a negative feedback loop. As AI capabilities improve, companies require fewer workers, leading to more layoffs. These displaced workers then spend less, which in turn pressures corporate margins, forcing firms to invest even more heavily in AI to cut costs, further accelerating the cycle. A small but critical sentence in the report, which many readers may have overlooked, states, "The velocity of money flatlined." For those unfamiliar, the velocity of money measures how quickly currency circulates through the economy. High velocity occurs when a newly paid worker immediately spends their paycheck, while low velocity occurs when they save most of it. The report implies that as AI displaces white-collar workers, this velocity will plummet simply because people will have less money to spend. What's compelling is that the velocity of money has already been in a decades-long decline since its peak in the 1990s, suggesting the average worker has been under pressure long before now, arguably due to globalization and automation. In this context, AI acts as a powerful analog to those forces, only instead of work being outsourced to cheaper labor and machines, it's being outsourced to AI and computers. However, most recent layoffs are reportedly not due to AI. A point even OpenAI CEO Sam Altman has made, which we will return to later. The report's dystopian 2028 scenario supposedly began in 2025, when companies realized they could replace their software as a service, SaaS, products with AI. This reflects a current market trend, as many software company stocks have been faltering under the assumption that AI will render their offerings obsolete. This brings us to the report's first core argument, the replacement of SaaS by AI. This argument, like many AI maximalist claims, overlooks a critical factor. Even if the technology is ready, the trust is not. These systems have not been sufficiently battle-tested. Consider Replit, which launched an AI agent to optimize code, only for the agent to wipe the company's entire database. Large corporations witness such incidents and conclude that, for now, the risk far outweighs the reward. It's akin to arming every employee with a handgun instead of hiring dedicated security personnel. While it theoretically enhances security, it practically increases the odds of a catastrophic mistake, especially without proper training. Indeed, there are already numerous instances of employees accidentally leaking confidential data via AI. To their credit, the authors present a counterargument. SaaS companies won't be outright replaced, but rather forced to adopt AI to enhance their existing tools to avoid obsolescence. This, they foreshadow, will lead to a race to the bottom, resulting in fewer SaaS companies with smaller workforces and thinner profit margins. Yet again, this forecast runs into a natural hurdle. If companies compete on AI to the extent the report imagines, the pressure to cut corners will skyrocket, dramatically increasing risk. Some would argue this is already happening, as the current AI race forces companies to release ever more advanced products so rapidly that it prevents a stable rate of adoption and exponentially raises the chances of something going horribly wrong. A few large companies, most notably Apple, seem to understand this and are taking a more measured approach to their AI rollout, a strategy the market appears to have rewarded in recent weeks. In the third part of the report, the authors pivot to another potential impact by 2028, disintermediation. In simple terms, AI will enable consumers to access the best products and services directly, bypassing the moats created by brands and consumer habits. For example, instead of manually checking multiple websites for the best flight price, an AI agent would do it for you. The authors suggest that the evolution of crypto payments could even allow these agents to transact financially on a user's behalf, using stablecoins on networks like Solana. The key takeaway, however, is that users might bypass a site like Kayak entirely in favor of a personal AI agent, a logical but dire outcome for such intermediary companies. But beyond the fact that many people might actually enjoy the process of booking a vacation online, the problem of trust reemerges. It is one thing to trust an AI to check code or write a blog post. It is another thing entirely to entrust it with thousands of dollars to book a family vacation. A single mistake, or even just reading about one, would be enough for many to decide the risk isn't worth it. The fourth part of the report delves into the main argument, the replacement of white-collar jobs by AI agents. The authors note that white-collar jobs constitute 50% of employment and drive 75% of all spending. In their words, white-collar workers are the economy. They highlight the exponential evolution of AI agents with a real-world graph and make another critical assumption that many seem to have missed. White-collar openings were collapsing while blue-collar openings remained relatively stable: construction, healthcare, trades. They later explain that this loss of white-collar jobs would push more people into blue-collar professions, thereby suppressing wages in those sectors as well. However, this seems to dramatically underestimate future demand. Governments worldwide are shifting their focus toward massive infrastructure spending. According to BlackRock, approximately $85 trillion in infrastructure investment will be needed over the next 15 years at current costs. BlackRock's CEO, Larry Fink, has stated that the U.S. alone needs hundreds of thousands of new electricians, to say nothing of the millions of other blue-collar jobs required domestically and tens of millions needed globally. This suggests that even if a large number of white-collar jobs were displaced, there would be immense, non-automatable demand in the blue-collar sector. This demand could be further amplified if commodities are entering a new supercycle, a real possibility given historical trends. Commodities tend to follow a 30-year cycle of 15 years of rising prices followed by 15 years of falling prices. With the last cycle peaking in 2011, prices may be at or near a bottom, poised to rise for the next decade and a half. Such a boom would trigger an even greater surge in demand for blue-collar jobs, leading to higher wages and better benefits. There is also the social dimension. Blue-collar work is often cooperative and face-to-face, which facilitates unionization and collective bargaining. This outcome seems highly likely under the circumstances and would break the doom loop, the report predicts. The report is fundamentally based on the assumption that white-collar work will remain the dominant form of employment and consumption, when historically it was the blue-collar sector that drove both. This puts the report's terrifying quote, "There was no natural floor to the labor market," into perspective. Not only is there likely to be a floor, but that floor is likely to rise. It will just be a different color than office workers are used to, blue instead of white. This leads to a problematic assumption in the fifth part of the report, that displaced white-collar workers will simply accept low-paying blue-collar jobs that, according to the authors, will also eventually be disrupted by robots. On the contrary, if AI evolves as imagined, it is the crafty employee who will use it to replace their employer, not the other way around. This is already happening, as new startups leverage AI to operate with a handful of people instead of hiring dozens of workers from low-cost countries. This underscores a point the report glazes over. The white-collar jobs most immediately at risk are not in the U.S. or the EU, but in outsourcing hubs like India and the Philippines. The fact that large corporations continue to hire from these countries suggests that the threat of AI replacement is still perceived as relatively low. This brings to mind the concept of AI washing, where a company fires workers for other reasons but publicly claims they are being replaced by AI. As mentioned earlier, Sam Altman recently alleged that many companies are engaging in this practice. This is unsurprising when considering that as much as 40% of modern employment consists of what anthropologist David Graeber famously termed bullshit jobs, roles that are fundamentally irrelevant or could be easily automated. Given this, it's likely that many of the positions currently being replaced by AI fall into this category. People will cling to these roles for as long as possible, but those who are displaced will likely either transition to blue-collar work or go solo, using AI to compete with their former employers. In the sixth part of the report, the authors explore the daisy chain of correlated bets, highlighting how scenarios discussed in their future set narrative are already unfolding today. They shine a light on the private credit market, which has faced recent issues due to its exposure to the software industry. The report speculates that in the future, the intersection of private credit and insurance could create systemic risk. They also examine the impact on mortgages. If people lose their jobs, they cannot pay their debts. Banks, wary of AI's impact on job security, would become less likely to lend. This would cause housing prices to fall as homeowners default and prospective buyers are denied mortgages, ultimately pressuring both the economy and the markets. The authors claim that any response from central banks would be ineffective because the downward spiral would be driven by technology, not financial conditions. In the final sections, the authors conclude that governments would need to intervene with some form of universal basic income, UBI, funded by taxing the very companies building the AI. They also make one last argument: human intelligence, once a scarce resource, will be made abundant by AI, and will therefore lose its economic premium. As you might imagine, Citrini's controversial report drew widespread commentary. What few expected, however, was a direct rebuttal from Citadel Securities, one of the world's most profitable hedge funds, effectively pitting their analysis against that of Lotus Technology Management. The Citadel report begins by pointing out that job postings for software engineers are actually rising, the opposite of what one would expect if these roles were being replaced by AI. This data supports the earlier anecdote: if white-collar jobs were truly at risk, companies would not be hiring foreign workers, who would logically be the first to be replaced. Citadel's authors also note that AI usage has not been growing exponentially, with only around 10% of people using it for work. This is likely because the rapid proliferation of new AI tools makes it difficult for users to keep up, let alone master them. Most importantly, Citadel directly attacks Citrini's argument about the premium on human intelligence. Displacing white-collar work would require orders of magnitude more compute intensity than the current level of utilization. If automation expands rapidly, demand for compute definitionally rises, pushing up its marginal cost. If the marginal cost of compute rises above the marginal cost of human labor for certain tasks, substitution will not occur, creating a natural economic boundary. Citadel also flips the argument about AI's impact on wages, noting that AI adoption drives productivity. Increased productivity creates a supply shock, making goods and services cheaper and allowing for more consumption, while also boosting corporate profit margins. As circumstantial evidence, Citadel provides a chart showing that new business formations have increased exponentially in recent years, a sign that determined individuals are already using AI to become their own bosses. Like Altman, Citadel sees little evidence that AI is disrupting the labor market for now. While that could change, it will be difficult to distinguish between layoffs caused by a weak economy and the elimination of superfluous roles versus actual AI-driven replacement. Even if AI does begin to replace workers, Citadel argues that coordination frictions, liability constraints, and trust barriers will be nearly impossible for AI to breach, ensuring a continued need for human involvement, if only to assign blame. The penultimate sentence of Citadel's rebuttal is truly profound. Today's secular forces of aging populations, climate change, and deglobalization exert downward pressure on potential growth and productivity. Perhaps AI is just enough to offset these headwinds. The point about aging populations is particularly salient. With birth rates falling globally due to rising costs, the supply of skilled labor is set to shrink. If AI were to suppress wages as Citrini projects, it would likely lead to even lower population growth, eventually creating a labor shortage that would drive wages and benefits back up. In practical terms, then, AI could function just like the transformative technologies that preceded it. While there will undoubtedly be disruption, the system eventually finds a new equilibrium without fundamentally altering the underlying economic cycles. The dream of achieving economic escape velocity through a digital AI god is compelling, but the hard constraints of economics, and perhaps nature itself, will always have the final say.